Market actually now, after that initial cut, has now stabilized at close to the 7600 level. So let's get a fundamental view in. Joining us now is our market master, Tirthankar Patnaik, Director Institutional Research at Religare Capital Markets. Tirthankar, hi, good morning. After many days, we're actually seeing a considerable fall in the first 1 hour of trade. Would you go ahead and use this as an opportunity to buy any stocks? And if yes, what would top your list now?
Well, I think what we have been sort of looking at closely over the last 1 week or so has been the IT pack. We've seen that opportunities are arising for large cap IT stocks, Infi, TCS, Wipro, HCL, wherever we believe that the market has been a little over enthusiastic in taking its positions off IT. We've been trying to build up positions there really.
Okay, let me tackle the bank Nifty. It did not participate in the rally in the past 3 or 4 days, and today is a bit of an underperformer compared to the Nifty itself. Lost, I think, about 1% at this point in time. Yeah, 1.2% lower. How would you look at the PSU banks and the private sector banks?
Well, private sector banks, we are overweight. We like them. I mean, we believe that if you want to play a macro recovery, this is one sector that you would definitely be overweight in. In terms of the PSU banks, our concerns on asset quality have not gone down really, but we believe that there is valuation sentiment driven valuation that will definitely drive the PSU banks space right now. So will be difficult to will be amiss in not having some positions there as well. So SBI is one bank that we really like in that space. On the rest of the PSU space, we are neutral at this point. So our positions are not much higher than what the Nifty positions are. So what happens is that we are participating in the upside, but we are cognizant of what the asset quality concerns are also at this point.
Okay, so because of the monsoon concerns leading to more bad assets, or because of these loan waiver issues, you're not changing any stance because you anyway were neutral on them?
Yes, that is correct. That would be right.
You said you would buy IT stocks at this juncture. What would top your list? Will it be only the frontliner names, or would you look at some mid-cap IT names as well?
Oh no, our analyst has been fairly clear that mid-caps have, once the rupee has stabilized, there's not much upside in the mid-cap names. So one of the themes that we've been pushing all along has been that clients should shift from the mid-cap space to the large-cap space. Okay. And one of the things that we've also seen is that the kind of earnings upside that you could have seen, the margin upside that you could have seen in mid-cap space given by their performance has not really come through. The kind of margin differential that exists between large-cap and mid-cap space has not really narrowed that one would have expected from the mid-caps outperformance. So, we are short mid-caps. On large caps, yeah, definitely the frontline names.
Okay. Do you expect to see any major pre-budget sell-off in this market?
Unlikely. Looks very unlikely. The participation levels have hitherto been so low that one would not expect any kind of major sell-off from our retail desks, and we have more than 500,000 clients. So in the retail desks, we see that participation from clients has been majorly increasing. Enquiries have been increasing. The number of clients that trade on a daily basis, that ratio, that has also been increasing. So I don't see any kind of major sell-off, barring a global negative, before the budget really.
How much should we worry about the monsoons or the lack of them or their delay, Tirthankar? Early morning we got a Citi report from Rohini Malkani saying that if it was as bad as in some El Nino years, she would shave off 0.5% from the GDP. How will you play it as a market man?
I respect Rohini's views there. See, basically, our IMD has been slightly a little slow in pointing out the severity of the slowdown that we can see in the monsoons this year. Earlier on we were saying about 5% of the LPA. Now we are saying it could be 93% of the LPA. The numbers in the first week have been about 44% lower than what they typically are there of the LPA in the first week or so. Clearly monsoons are a worry. Our worry is also on the fact that last year's agri numbers have been fairly good, very good in fact. In fact, the fourth quarter numbers were quite high. So from that perspective, there's a high base effect as well, and we definitely believe agri could surprise on the negative side. And our numbers would be around between 2 and 2.5% for this year really.
Okay. How would you play it in the markets? Because I noticed that you have quite a few FMCG buys. If the monsoon turned out differently, would you continue to maintain any of your buy-rated stocks? I understand ITC, Dabur and Britannia are your buys.
See, ITC, Dabur and Britannia are not really monsoon plays, right?
Okay.
If I was worried on monsoons, HUL will be one stock I'll be worried about. I'll be worried about Mahindra and Mahindra. So those are stocks that we would be worried about. Overall, from a consumer staples perspective in the model portfolio, we are negative. So this is one space where we believe that, agri is a near-term threat anyway. But overall, we believe that given that we are looking at still below potential 5.25%, 5.5% kind of growth, consumption is not one place where one would be going in. If at all you want to go in, it would have to be in the discretionary space. Low-end consumer discretionary, places like Titan, places like Jubilant are stocks that one would still find some solace in.
Do you think the rally in the real estate sector is done, Tirthankar, or is there more to go there tactically?
Well, no, not really. I mean, the rally in the real estate space is likely to come in later, not at this point. We are not likely to see the fortunes of real estate companies change in the next 2 to 3 quarters, given the way the macro is, given where we find ourselves in the credit cycle. So that's not going to happen anytime soon. You do see some kind of sentiment, positive numbers, but again, one has to be very, quite selective in where one goes in the real estate names. If it's a company like Shobha, Oberoi, Prestige, that's where we'll be comfortable in. But amongst other than that, if you go to HDIL or Unitech or DLF, one would be cautious really.
From current levels, how much of a gain are you seeing in the indices by end of 2014 or FY15 end, whatever you're comfortable?
See, from a fiscal year perspective, we are expecting another 8 or 9% to go on the Nifty. After the budget, we were saying that there was the upside of about 11% for the market. We are steadily going up there. This is not, we're very clear. This may not be a straight move, one-way move, but overall, we should end the year at roughly 15.3 times FY16 earnings by the end of FY15.
And what should one realistically expect from the budget this time around? I mean, what is the market trying to factor in?
Well, I hope the expectations get realistic. What one would be looking for is a roadmap. What is it that they want to do in terms of getting the economy back on track? That's the key thing. The finance minister has been meeting various representations all around. What we are not expecting is any kind of deviation from the fiscal prudence path. So, we believe that what was put in place in October 2012, getting the fiscal deficit in line will continue. What we are not expecting is any kind of change in diesel rationalization. We are, in a base case scenario, assuming that diesel prices will come back to, market levels and sort of remain there. Those are the things that we are expecting. We are also expecting some kind of positive sentiments, positive news on the DFC, the Dedicated Freight Corridor. The Prime Minister, the President yesterday spoke about getting a diamond quadrilateral. More importantly, we would look for the DFC. And of course, some kind of a timeline on the GST would be very helpful indeed.
Okay. Tirthankar, just to come back to the old question, revise for us the hierarchy of sectors that you like most.
Okay.
Or stocks.
Okay, so our thesis, yeah, sure. So our thesis has been this time that we want to play a little more domestic over global at this point. So IT as a sector is neutral for us. Financials as a sector is neutral for us, but we are overweight private banks. How we are playing the domestic side is that we are massively overweight cement and we are overweight on energy. So both are places where we believe the macro turnaround and a reform turnaround, the reform uptick should see these stocks doing fairly well at this point without the worry that one would have with the infra space where where leverage concerns are still abound. So beyond the valuation, beyond the plain valuation multiple uptick, one would be looking at definite changes from sectors like cement and energy, and that's where we are overweight on. What are we negative on? We are negative on consumption, as I pointed out. So consumption, consumer staples are places where we are negative. If you want to play consumption, it would have to be low-end consumer discretionary.
Okay, I noticed that you have a large presence in the auto sector as well. Between Hero Moto and Bajaj Auto, which one do you think could give better returns this year?
So Hero Motors is one place where we think that numbers could still surprise on the upside from current levels. Our thesis in the auto space has been that we are positive two-wheelers over four-wheelers. In terms of an uptick from a sentiment perspective, we believe that the top beta could be in a mid cap like Ashok Leyland, which is a pure play CV maker really.
Okay. Do you expect more steam in the mid-cap rally at all? We have seen them outperform the major indices in the past 4 weeks or so.
Well, in the near term, one could see some amount of momentum keep, continuing purely by the inquiries one would see on the retail side really. There one sees that large cap names have limited upside, at least from a retail perspective, and mid caps is where they play, and mid caps is also a space where quick returns are sort of expected. So I would simply say that in terms of participation levels, mid caps have some way to go. En masse, the mid cap index has properly outperformed the large cap index this year. One would imagine that if the macro recovery sort of continues, this outperformance is likely to continue. Let's not forget that over the last 3 years, when the macro was in a downturn, when we were seeing GDP growth numbers steadily coming lower than the previous years, mid cap indices had underperformed the large cap index, and one would see that totally turn over the next 2 to 3 years as one sees the GDP growth numbers come higher up. So mid caps, we are constructive from a longer term perspective. In the shorter term, one would basically see participation provide support to the mid cap index.
All right, Tirthankar, we leave it at that. Thank you for joining us. So that's the word coming in from Religare. They don't expect any major sell-off in the market ahead of the budget. They're still quite bullish on the markets.